What's good? What's good? Welcome. Today I'm going to go over a study, and the study is centered on finding the answer to this question. The question is it better to take trends after it has mean reverted? Okay. Believe it or not, it's a simple question, but it's actually pretty difficult to find an answer, a resolution to that, because there's a lot of different ways you can identify trend. There's a lot of different ways you can say, oh, it's mean reverting or whatever. So I'm going to go over, I pulled, it's usually just me and my brain, but I pulled sources from from other sources, okay? I found this white paper on trend following on Winton Capital Management, Winton Investment. I don't know. They're a huge business in England, but they published a white paper on trend following, and they said in the white paper, deep within it, it tells us the system, and it's a moving average system, just like the one you see on the screen here. And it's an exponential moving average. So when the exponential moving average, the fast one, it goes above it, we go long, and we hold until it goes below it, and then we get out. Okay, and that's that's one trending system, and I have a different trending system also, and I tested both of them. And what I want to do is see, well, what happens if we continually and constantly take trends. We always trade the system. We always take the signal. Always, compared to, well, what happens if we only take the trades if it had just lost, if it had just mean reverted? How about then we take the trades? And I have some data for you. This has been a huge task, but I think I have finally found a conclusion to this question that I've been asking. And the answer is, before you even start, the answer is that it is more accurate to trend after it has lost trends, after it has mean reverted. Then you take a trend, okay? It is conclusive, all right? So this is the study. I did a study on the daily chart, the 60-minute chart, and the 5-minute chart. That is 3 very different time frames. And I will tell you right now, I'm pretty sure we find the exact same answer in every single time frame. Okay, so let's go to the daily chart. And you can see this is a trend following system, just like the one you saw on the chart. And by the way, this is the system underneath it right now. Right now, I'm actually not doing the exact system, okay? But whatever. It doesn't matter. But I explained it. And that's what it does, okay? And over time, you can see risking $1,000 a trade or so on the daily chart, $1,000 per ATR. So it's very different. I don't know how much money. I didn't look at how much money you need the account to trade a system like this, but I made the risk high enough to where, silver or gold at these levels right now, like if you control one contract, it's going to be worth way more than in 2005, right? Because I'm testing the past 20 years, 2005 to 2025. So what I need to do is make the risk high enough to where the current and present day values are not weighted heavier than 2005. We want all equal, okay? So that's why you see these big numbers. But anyways, we tested. So I strategically picked, not at random, but not based on performance. I picked them based on volume and liquidity, so volume. These are 9 symbols. I picked on volume and sector. So we have ES. We have the S&P 500. We don't need NASDAQ. We don't need the Russell. We don't need Dow. We have the S&P 500. We don't need anything else, okay? Because they're correlated. We got gold. We don't need silver. They are correlated. If you look at them the higher time frame, they're so correlated. Crude oil, good. Euro currency, I don't need the yen. I don't need British pound. They're not exactly correlated, but they are similar. Same with bonds. You don't need the 30-year bond. You're using the 10-year bond. It doesn't freaking matter. So I've narrowed the focus to 9 different markets. We have included Bitcoin since 2021. That has been active. So having a different sector, cryptocurrency, yeah, and it has enough volume to trade. So we are definitely adding that. Copper, natural gas, and corn. We don't need wheat. We don't need soybeans. All right, that's enough. But I don't want to beat the horse or whatever because the charts look so similar. Corn, soybeans, what the hell is the difference? It's when they go up, like the tide goes and brings them all those eggs up like that. So most of the time on the higher time frames. So anyways, that's why I picked this bundle. And another reason why I picked this bundle is I don't want to trade a fucking ton of symbols because then your margin requirements goes up. That means the account value you need to actually be able to trade this type of portfolio goes up, and I don't have that. So let's go ahead and look at the numbers. Remember, what was the question? The question was, is it better to allow the trend to lose, or allow the trend to lose once, the trending system to lose once before you start trending it? Because I don't agree with it. Oh, let's trend all the time. You're always pulling the trigger. It just seems stupid to me. And I needed data to show me that. So we get here on the daily chart, trading every single symbol across all these symbols across 20 years. We see profit of 3.7 million. Fantastic. Really good results. You can see the standard deviation is 467,000, which is pretty high. You're going to probably have a shitty Sharpe ratio, but it's okay. The return is what I'm looking for. You do see a $500,000 drawdown multiple years, but overall you make great money, 3.7 mil in 20 years. Now we go to trading only after we have lost a trend. So it's more ripe for a trend. That's our theory. And we get 3.3 million. So very close, very, very similar to how much money. I mean, we're only 400 grand off, which is a very small percentage of, the total over 3 mil. So a very similar result, but you have a lower standard deviation. So you do get more straight line and streamlined results. So that's the daily chart. So I'm like, all right, well, does this system work on the smaller time frames? And I applied the exact same system, the exact same number of bars for the moving averages, the exact same everything to the smaller time frames. This is the 60-minute results. 60-minute, each hour is a bar. We have lowered the risk per trade. The only difference was lowering it from 10K to 2K, because otherwise with higher frequency trading 10K at a time, you're going to get even bigger results. You're going to get $1 million per market, not $1 million per portfolio, right? So we do have to lower the risk because you're trading so frequent, and that should make sense. And the risk is less. Like you don't have as big of zones. But anyways, this is the portfolio. This is the system. We get 4.4 million if you take every single symbol. And now because we're trading frequently, I have included a trade count. The trade count is 930 trades. So let's say 4.4 mil, 900 trades. Now let's trade only if we had just lost a trending trade. We didn't. The system did. But we didn't take that losing trade. We allow it to mean revert once. Then we turn it on. And this is what the results are doing that. We make 4.4 mil. That's the exact same amount of money. 4.4 mil, 4.4 mil. Well, what's the difference? Well, we take 60% of the trades, bro. That means we take 600 trades, they take 900 trades. So our reward per trade is about 7,000, and their reward per trade, trading every single time, all the time, is 4,700. So again, the answer again, not just on the daily, but on the 60-minute, says to us that trading after losing, only trading after losing. I won't take a trade if we just won a big trend. I'm not going to ask the market to trend again. I'm going to wait for it to lose. And what happens is, again, that we get about the same amount of money, and we take less trades, and we're more streamlined with less drawdown. You see the standard deviation is much lower, 380 versus 470K trading every time. Again, it's more logical. I think that's logical. So again, the results show us that it's streamlined. It's better. Now, I did do version B, where we have, instead of we changed the duration of the moving averages on the 60-minute chart, and I wanted to see this variation and see if we get any different results. In this case, we made 5.3 mil doing the smaller, more trades, but you take 1,800 trades. You can see that the trade count doubled. The trade count doubled, making the moving averages very, very tight. You're trading more often. But in 20 years, 1,800 trades, in reality, that's actually not that much. But 5.3 mil, trading all the signals. But now, how much we make? 6.6 mil, only trading after losing. So now we're comparing 5.3 mil reward versus 6.6. Obviously, 6.6 is a lot more. What happened differently? Well, I can tell you what we did differently. We only trade after losing. We allow the system to lose. And the system losing is a signal to us to say, all right, we're going to take that next trade. And if we win that trade, we sit out again. And we allow it to lose. And then we trade again. And you can see that we make more money. And we take 1,100 trades versus 1,800 trades. We trade less, we make more. Clearly, that's the right answer. It's way, way, way better. Less drawdown, more accurate of trades, more accuracy. And what is this like? Is this conclusive? Well, I can tell you right now, I didn't test it on one symbol. I tested it on 9 over 20 years, over various different time frames, various different trade frequencies on these time frames, and all of them are pointing in the same direction, that you should trade trends after losing a trend. So after the trends suck, after the trenders lose money, that's when you start trending. It is generally better. Now, for the most important part, we're going to the 5-minute time frame. Do we see the same results on the 5-minute time frame? Remember, frequency is going to be skyrocketed. I tell you, skyrocketed. For the sake of time, I didn't want to test every single symbol, although I did. No, the 5-minute, the testing takes freaking ever, dude, on the 5-minute time frame. But I tested S&P, gold, and crude oil for preliminary tests. Okay. I'll get more of the data soon, but I just wanted to get the answer. I kind of wanted to see a sneak peek, and here it is. 5-minute time frame. We're taking 1,500 trades. Remember, we were doing 1,500 trades in 20 years over 9 symbols, and the whole portfolio you traded 1,500 trades on the 60-minute time frame. Now we're trading about 1,500 per market in the 20 years. So our frequency skyrockets when we're on the 5-minute time frame. I did include commissions. I did not include slippage. We aren't taking. I would say this is no longer swing trading. 5-minute time frame. It's not a day trade. You're certainly holding it more than a day. Many days. So I guess you could call it swing, but I could look at the average holding time. Let me do that quick. This is system 1. on the 5-minute time frame. 1 alpha, yes. Okay. The ES, sure. Let me get the average holding time. Average, man, I don't know where it is. Trading period, percent of time in market. Is there average holding period anywhere? Sorry about this, mate. There's definitely average holding period somewhere. Average time in trades. There you go. 5 days. All right. So the turnover rate, you take a new position every 5 days. It's on very well average, like really general. But average time in the trade, the holding period is about 5 days. So about a week. You're about holding it for a week. So it's really not a day trade. When you think of a 5-minute time frame, you're thinking like, oh, day trading. This is not a day trading system. It is following trend. But anyways, this is taking every single symbol or every single signal. You make 588,000. Great. What about if you take trades only after losing? You make 669,000. Well, that's not much different, peasant. Well, it is, because you're taking way less trades, dude. You're taking 4,300 trades. You're taking 2,800 here. You're taking less trades, and you're making more money. You've nearly doubled how much you can make per trade, which is phenomenal. That's exactly what you want. That's why you see less drawdown. That's why you see less standard deviation, which gives you a better Sharpe ratio, which everything is better. Again, trading trends after losing a trend. Now we go into system 2, which is a different type of trending signal. Okay, I'm not going to explain it in depth because it's private. This one is, published, is the normal trend following technique. I have thought of my own, but it's a very similar type of system. Okay, it's a trending system. That's why you should see similar results. But let's see if this system did the same. You make 827,000 trading all the signals, so 827 grand. Boom. Trading the trend after losing a trend. Only after losing a trend. If it didn't lose the trade before, I will not trade it. I will miss the trend. Fine. Leave without me. I need to see you lose first, and then I'll get in. If you go sideways and mean revert at least once, I will start trending. And what do we get? 1.2 million. So from 800 grand to 1.2 million, clearly a huge increase. And what do? We trade less, dude. We trade 8,000 trades versus 11,000. The answer again is proven right. This is amongst all the these are amongst many different symbols, okay? And I want to paint the picture that it's robust. That's my thesis to myself here, is like, can you trust this? Is this statistically significant? Is it better to trend after losing a trend? The answer is yes, because I've tested multiple different time frames in 2 different systems. They're not the same system. In fact, this one doesn't even use a moving average. It does not use moving averages at all. So it's a lot different, dude. Anyways, the last and final test of this video, we did the 60-minute with that system. $2.8 million across all the different symbols. Again, trends make money. At least these ones do. $2.8 million over 2,500 trades. Fantastic results. I love it. I love the portfolio. Now you only take trades after losing. Again, $5.1 million. You have nearly doubled your profit, and you've traded less. So 2,500 trades to 1,800 trades. The answer again shoves it right here in front of us saying that taking trends after losing a trend is better. It is better. Overall, over 20 years, 9 symbols, multiple different time frames, they're all saying the same thing, man. It is better to take trends after losing a trend. So this goes, okay. I know I said last point. All right, one more point. Okay, one more point. This is a really, really interesting point. Trading the market's difficult, okay? What if this data is showing me, it is showing me that trends are good, but what if this data is showing me like, what is the trade here? Well, the trade is obviously the difference between 2.8 mil and 5.1 mil here. The difference is all these different symbols have the exact same thing going on. You're trading less and you're making more money. So what does that tell us? It tells us that these trades that we're omitting are losing trend trades. So that means we could technically mean revert, which means do the opposite of the trend signal after a trend. So the trend happens, and then we immediately flip our bias to say, all right, we're no longer trend followers. We're mean reversionists on that next trade. And it's a way to amplify the results. And I think would be successful enough because it's back tested in all these different time frames. Like, how can you cheat? How can you curve fit when I'm doing 9 different markets? When I'm doing a 5-minute time frame, what does the 5-minute time frame have to do with the daily time frame? I mean, I'm holding for 5 years on the daily time frame. I'm holding for 5 days on the 5-minute time frame, and yet they yield the same results. They yield the same answer to the question of it mean reverts after a trend. That's plain and simple. So the answer that I've been trying to get this whole time is not actually the answer. It is the answer that I'm looking for, but it's actually revealing another trade to me. It's revealing the trade that if it does happen to trend in a huge win, we should actually, instead of stopping trending afterwards, we should actually do the opposite. We should mean revert. We should mean revert that next trade. So I want to show you the results. I think this is copper of doing exactly that. You can see looks phenomenal. Basically, you can see that this trade, it went up and it trended. This red line did not cross the blue until way lower here. So that was a completely good uptrend. And the trend ended, and then we go long because we're no longer trend fouling, we're mean reverting, and we win. We win those little mean reversion trades. So let's take a look at natural gas. I think that's the last one I have to test. So, I mean, looks pretty cool. I think that is the real trade here. And I feel pretty strong about it. I don't even want to share it, but it just does seem to be the way to do it. Natural gas. I mean, those charts look pretty similar, dude. And it's over 20 years. I mean, what does natural gas have to do with copper? Almost nothing. I mean, they're both valued in dollars, but they're not carried by dollars like gold and silver, like that S&P 500 inflationary. It's not like that. I mean, if you look at natural gas chart, it went fucking down. So there is something here, in my opinion. And if you see enough data, you can see that I can tell you right now that we have found that answer. Finally. I need enough data to show me, but I'm not even done yet. I'm still going to be doing a third trend following system, and I'm going to scour different ideas or whatever. But there is a third trend following system that I'm going to see if these same results happen. But so far is very conclusive that you don't want to, that you do want a trend after losing a trend, and you do want to mean revert after a big trend. Plain and simple, man. plain and simple. That's what it is. So I think we've revealed some trades here, and I think that there's edge there. I do. Across multiple time frames. So that's about it. Just wanted to get matter of fact and very data intensive on this one, but that's the way things work, man. At least what I'm looking for. So that's about it. I wanted to maybe show my portfolio, but there hasn't been much action. I haven't traded for a month because my signals aren't hitting. The market is dodging my signals, so I have to wait, but it's all right. We're looking at a lot of research here. Yeah, but I'm very excited that trending after losing one is so much better. The chart or the true trend followers hate this idea. I'm like, you guys are stupid. I asked on Substack, I messaged a hedge fund manager, $51 million AUM. Or no, I don't know how much he has actually. That was a different person. But I bothered this trend follower guy, CTA, real fund manager, and I asked him this. I triggered like, dude, why would you always take trends? Doesn't that seem stupid? Look at the drawdown. Like, why would we do that? Isn't there a better way? Could we just like allow it to lose before trading trend? And he said, all right, I'll get back to you. Or he said, because I asked him to talk about it in the podcast he has. Talking Trends podcast, Michael Melisinos. But he responded like, yeah, we'll talk to it on the podcast. Okay. I'm like, absolutely. Thank you. I listened to the podcast a week later. He's bashing this idea. He pretty much already doesn't like me just because I bring up another idea other than what he has. And if you look at his return, it sucks. Trend following sucks over these years because you're always taking trend. You're stupid for doing that. It's stupid. That is stupid. Yeah, it's overall profitable, probably. But, I mean, the past 2 years, these huge funds like Winton, like I was talking about, there's a few others. You're down 10, 12% in the past 2 years. That sucks, dude. So I guarantee you, if you allow it to trade after losing, if you allow it to lose first before trading and trending, I bet the drawdown's less. I do. So it's more accurate. So that's all. That's all I have to do. That's all I have to say. Thank you very much for listening. Peace until next time. Peace.